Welcome to our lecture series in International Financial Management. Today, we will talk about country risk analysis. Thank you for joining us. Country risk analysis is the systematic evaluation of political, economic, financial, legal, and institutional risks associated with doing business, investing, or lending in a particular country. In international financial management, country risk is a critical determinant of expected returns, capital allocation, and strategic decision-making for multinational corporations, banks, and investors. Country risk is not exclusive to emerging economies. Advanced economies also face elevated risks due to political polarization, fiscal stress, or banking sector instability. For instance, a U.S. energy company investing in Norway faces low country risk due to strong institutions and stability. However, the same investment in Nigeria would require significantly higher expected returns due to political instability, security concerns, and regulatory uncertainty. Political risk arises from government actions, instability, or policy changes that negatively affect foreign investors. Examples include expropriation of foreign-owned assets, sudden changes in regulations, capital controls, political unrest, or international sanctions. Venezuela nationalized oil assets owned by foreign firms, and Russia restricted foreign companies after sanctions in 2022. Economic risk reflects a country's ability to sustain stable economic growth and maintain macroeconomic balance. This includes volatile GDP growth, high inflation, persistent fiscal deficits, and unsustainable public debt. Turkey's high inflation and currency depreciation from 2018 to 2023 and Greece's sovereign debt crisis from 2009 to 2015 are prime examples. Financial risk focuses on the stability of the banking system and capital markets. This can involve weak banks, poor financial regulation, excessive private sector leverage, or limited access to global capital markets. The Asian financial crisis of 1997-1998 and the global financial crisis of 2007-2009 highlight the severe impact of financial risk. Exchange rate risk stems from volatility or misalignment in currency values, including sudden devaluations or the collapse of fixed exchange rate regimes. The Thai baht collapse in 1997, the British pound crisis in 2022, and Argentine peso devaluations are historical examples of exchange rate risk. Institutional and legal risk concerns the reliability of contracts and investor protections, often linked to weak rule of law, corruption, or inefficient courts. Poor institutions significantly increase transaction costs and uncertainty for businesses operating internationally. Country risk is measured using a combination of qualitative judgments and quantitative indicators. These indicators include sovereign credit ratings from agencies like S&P, Moody's, and Fitch, credit default swap spreads, and country risk indices. For example, high credit default swap spreads on Argentine sovereign debt signal elevated default risk. Firms and investors manage country risk through strategies like geographic and currency diversification, political risk insurance, and joint ventures with local partners. Multinational oil firms often partner with state-owned enterprises to reduce political risk in foreign markets. Country risk impacts firm valuation by requiring higher discount rates, conservative cash flow forecasts, and thorough scenario analysis. Projects in stable countries demand lower risk premiums compared to identical projects in high-risk environments. Country risk analysis is a cornerstone of international financial management, enabling better capital allocation and asset protection. By understanding and quantifying political, economic, financial, exchange rate, and institutional risks, decision makers can enhance long-term global performance. Thank you for watching our lecture in International Financial Management focusing on country risk analysis. See you at the next lecture.